All right. Today is Sunday, August 1st, a whole new beginning. Or not. It depends on how you look at it. For some, it is turning the page, leaving the bad behind, and starting a new, fresh, optimistic beginning. For others, it is the continuation of the past, hopefully a continuation of the good times. We start tonight with In Focus. And ladies and gentlemen, we start with the great divide, the contrast between euphoria and fear. Yes, euphoria and fear. Two extremes, no middle ground at all. These are the polar opposite opinions in the market right now. Let's start with euphoria. For example, here's a headline saying that the Nasdaq is about to hit 15,000. Do I hear 30,000 already? This is extreme euphoric sentiment. Likewise, institutional investors, these are the so-called smart money, have turned bullish on U.S. equities for the first time in the year. While sentiment remains negative on European and Asian markets, the sentiment from institutional investors on U.S. markets have turned positive for the first time this year. Likewise, we're seeing speculative bets by hedge funds betting that the US dollar will rise higher, and this is a signal for more bullishness. In addition, every attempt for a correction in this market, every dip was bought by retail traders. The sentiment remains extremely bullish among retail traders, buying every single dip in the stock market. Now, let's contrast that with the fear side in the market, and this is for now, is circulating around the seasonality element. Yes, there is fear regarding inflation. There is fear regarding Delta. There is fear regarding bloated valuations in the market and perhaps peak growth for certain stocks and certain sectors in the market. But the fear we want to talk about in this video is the fear in seasonality and the fear of the peak in sentiment. Stock market investors are staring down the barrel of seasonal weakness for the next 3 months. What are they talking about, by the way? They're talking about the seasonality, where the months of August and September, historically speaking, are the worst months in the market. Whether due post-election years, the past 10 years, the past 20 years, or even going back all the way till the 1950s. Furthermore, when we talk about the peak in sentiment, take a look at what happened in emerging markets, for example, losing all of the gains for the year. Likewise, we have seen a massive correction in Asian markets, specifically the Chinese market, in the last few weeks, where the Chinese tech bubble has popped. In addition, we have Robinhood warning that retail trading is slowing down, specifically in cryptocurrencies. Is this a sign for the peak of the mania, peak retail trading, peak speculation? It means a lot. Now, what about Robinhood itself? Well, this week, it had a failed IPO, perhaps one of the biggest failures in the IPO market's history. Is this yet another sign for peak sentiment? And therefore, we have this battle between euphoria, a continuation of the trend that has been going on since the Fed took over the markets? Or will it be a tide turn where fear starts to take over? Fear that starts with seasonality, peak sentiment, and then it morphs into fear about the Fed's ability of keeping this market propped up due to rising inflation and perhaps slowing economic growth due to the uncertainty of the COVID-19 crisis, creating a stagflationary period in the economy. And you can see the contrast even by looking at the charts. Certain charts show that the worst is behind us, and certain stocks, big stocks, are turning the tide and the bullish momentum is starting to form. On the other hand, you have other gigantic stocks in the market showing extremely worrying patterns that perhaps the best is behind us and we should buckle up for the ride to the downside. This is the debate between the side of euphoria and the side of fear. Which one are you on? Well, how about we let the charts speak for themselves? And we start, per usual, with the 30 minutes chart of the SPY. Now, we had the cup and handle formation, which was a bullish formation resulting in a blast higher, surpassing the previous all-time highs. However, on Friday's session, We got a nasty gap down. And of course, the weakness on the daily charts were evident to begin with, but add to that the drop in Amazon stock, and now we have the ETFization factor in the market taking place. One of the largest components of the SPY, the Nasdaq, is Amazon. When Amazon goes down, it takes the entire index down with it. So the main question here, looking at this chart, it is still keeping the 438 level for support. But the larger question is, was this an isolated incident? Was this an isolated move, meaning the gap down due to the Amazon effect? And we shouldn't place a lot of stock on the move from last Friday? The answer is yes, Amazon had the larger impact in the move. However, the breadth of the market, the advance to decline ratio, was 2-to-1 in the declining side, meaning that it wasn't just Amazon that was trading down. There were many other names. Matter of fact, the majority of the market was trading down, and therefore there is confirmation of the weakness on the charts. One way to look at this is we have a bear flag formation. It's not going to play out so long as the chart is trading above 438. But if the chart starts to crack below 438, then we get a problem here, because another way you can look at the chart is, what if this a double top formation? In addition to the bear flag formation, it is starting to look eerily similar to the last double top, which led to a nasty correction. Short-lived indeed, but still nasty. What about the daily chart of the continuous contract on the SPY? Looking at the candlestick patterns, they remain bullish. There is nothing wrong with this chart at all. Looking at the candlestick pattern, trading above 4,384.5, it is consolidating on what it's called a bullish consolidation, a gathering of energy before taking another leg higher. But when you combine the candlestick patterns with the momentum indicators, we get a problem here. We have negative divergence on the RSI, and we have weakness on the MACD indicator. Matter of fact, we have a negative crossing imminent, creating red impressions on the histogram. Therefore, until and unless we see a turnaround in one of these momentum indicators, be it the RSI or the MACD, the chart remains worrisome. But let's say we continue to grind in this range, up and down, and say the RSI indicator starts to curl upward, ending the negative divergence. Then we have a signal that the likelihood is the SPY will blast higher. But so long as the negative divergences are intact, the likelihood is this is starting to look like a bull trap, luring us to buy the market only to surprise us with a nasty flush down. What about the Qs? 30 minutes chart. What's going on here? Unlike the SPY, the candlestick pattern is not that bad when you look at the Qs chart. We have a gap down, obviously the Amazon impact, yet keeping and rebounding from the range of 363 as support. And now we have somewhat of a bull flag consolidation. The rebound early in the morning was pretty strong, indicating that there is still appetite, at least from retail investors and options speculators, to buy the dip in the market, be it Amazon, be it Pinterest, be it any other stock that got whacked significantly throughout the week. Take a look at the Chinese stocks, for example. Traders are looking at these as an opportunity to swing trade, and therefore they're buying all of these dips. Will this continue in this upcoming week, or will the seasonality take over and we see more negativity? Now, looking at this chart alone, the 30 minutes chart of the Qs, there is little negativity, if any at all. The chart is still trading pretty close to all-time highs. The chart is keeping 363 as support. The chart is showing extreme bullish sentiment of buying the dip. Yet when we switch to the daily chart of the continuous contract on the Qs, it is not looking so hot so, trading below 15,000, which was the level to keep for the week, and then we have negative divergences on both the RSI and the MACD indicators. And this is a signal that the momentum in this chart has weakened significantly, even though the candlestick patterns alone on this chart are not bearish at all. But once again, absent of a repair job in the momentum for this chart, where the RSI turns positive again, where the MACD indicator turns positive again, this formation in the chart remains stay away from this one. Stay away from it until you get a confirmation from the momentum. Otherwise, this is appearing to be a bull trap that will create a flush down. What about the IWM 30 minutes chart? One way you can look at the chart is a formation of a bull flag, which should take the IWM higher, breaking above 223, turning it from resistance to support. The challenge in achieving this objective will be keeping the pattern of higher lows. The moment you see the IWM creating what it appears to be a pattern of lower lows, then that would be your signal that the chart is turning the other way around. Of course, you're not going to wait till the formation of lower lows before you make that assessment. You will know it right away if the chart fails 218 as support. That will be the warning signal that this bull flag formation is not going to play out. We're going to see lower lows for the IWM. What about the Dixie, the US dollar? Rebounding higher on Friday's sell-off, more demand for cash equals a rebound for the US dollar. And now the US dollar is trading above 92. As I showed you before, more and more hedge funds are making speculative bets that the US dollar will pop higher. In the past, the crowded trade was to bet against the US dollar. And once the Fed, quote-unquote, changed the tone from dovish to hawkish, I disagree with this assessment, by the way, but regardless, once they said we're going to retire the term of not talking or not thinking about tapering, we saw a short squeeze. All of those dollar shorts, the so-called crowded trade, had to cover, and that resulted in a rally, an impressive one for the US dollar. Now the crowded trade appears to be a bet that the Fed will taper, and therefore this will increase the value of the US dollar. And therefore, the crowded trade is long the US dollar. But if things go the other way, we will start to see abandonment of that trade, and that will result in a flush down in the US dollar. For now, the sentiment is strong among hedge funds and speculators that the US dollar will continue to grind its way back higher again. And the reason is the uncertainty and the weakness in overseas markets, in addition to the tapering fears. The weakness in emerging markets and the uncertainty, specifically in the Chinese market, is prompting Asian investors to de-risk and move to the quote-unquote safety of the US dollar. So for now, the sentiment remains bullish on the US dollar, and it is extremely hard to change that sentiment. Even though the Federal Reserve, in the last press conference by Powell, said that we are moving from looking at inflation as a parameter for tapering, and we are now looking at employment as the parameter for tapering. What does that mean? It means that your indicator for the moves in the US dollar will be employment reports. What do we have this week? We have the ADP jobs report, and we have the non-farm payroll report out of the BLS, the Bureau of Labor Statistics, aka the Big Jobs Report. So this will be a critically important week for the US dollar. And if it is important for the US dollar, it is also important for gold, because gold has been eyeing the US dollar like a hawk, watching every move and waiting and waiting and waiting. But as we say, Tricky Dixie is not going to make it easy for gold to anticipate and make its moves accordingly. When the dollar appeared to be weak, breaking below 92 after the FOMC press conference, led by Chairman Jerome Powell, gold traded higher. But on Friday, as we saw the sell-off in the market and more demand on the US dollar, pushing it higher above 92, gold is taking a retreat once again. It's going to be the inverse move of the US dollar. Yes, there are many factors impacting the price of gold. Gold has many enemies, by the way, among them the US dollar, but also the 10-year yield and Bitcoin. But as of late, gold has been tracking the US dollar exclusively. So this is the relationship that we're going to continue to watch in this upcoming week. Of course, the test for gold remains the levels of 1,830, 1,840, in or around that number. It happens to be the resistance level in the Fibonacci retracement. Gold knocked twice on that particular level, and it failed twice so far. Will third time be a charm? Remember the failed 2 knocks that Bitcoin did when it traded under 30,000. It tried once, it failed. It tried a second time, it failed. Yet third time was a charm, coinciding with the rescue operation from Dorsey, Musk, and Wood. Will this scenario be repeated for gold, where the first and second knocks are met with failure, but third time is the charm? However, absent in this situation is who's going to rescue gold? Doesn't even need a rescue. Moving on, you want to talk about rescue? Let's talk about yields, specifically the 10-year yield. Trading below 128 basis points once again. It is not pulling away decisively from that level, which keeps the hope alive that yields could, given the right factors and formulas, could pop higher and trade above 1.28 basis points once again. But the sentiment has turned significantly bearish as of late, be it Delta, be it the action in Asia, specifically in China, be it the deaccelerating of the rate in growth from giant technology companies, the likes of Facebook and Amazon. And if that negative sentiment remains with us and the seasonality takes over in August and September, well, guess what? We're going to see a lot more pain in yields. Yields could drop, in this case, the 10-year yield could drop down all the way to 1% if that negative sentiment persists. A sell-off in equities will drive investors to the so-called safety of bonds and the US dollar. And if that is the case, then the TLT goes higher. And this is a weekly chart for the TLT, trading above 149, the threshold, and the momentum indicators indicating that there is still plenty of room for the TLT to go higher. This chart will not be so-called overbought and overextended until the chart trades above 155, around 160. Then you're going to see the RSI, the MACD all being extended and readying for a pullback. For now, the weekly chart of the TLT still looks good. What about the VIX? 4 hours chart. We saw a mini pop resulting in a 17% gain or so in the VIX, trading above 20 briefly before pulling back once again. Looking at the MACD indicator, there is still the potential for another pop higher. So long as the VIX continues to create higher lows, the VIX could give it another shot to trade above 20 once again. This is at least what the formation of the charts are looking like. SPY showing a lot of weakness, the VIX showing a lot of appetite to trade above 20. What about Apple, the big one? 30 minutes chart. In the grand scheme of things, when you look at the chart, it is still trading within a range. 145 as support, 150 as resistance. But in the larger picture, are we seeing a bear flag formation succeeding a double top formation? And if that is the case, then we're going to have significant negative activities in Apple. And perhaps zooming out to a larger time frame will give us more clarity. Can we confirm this negative outlook on Apple? The double top and a bear flag formation? Let's see. Here it is, a daily chart of Apple. We see the double top formation clearly. You see the bear flag formation at the end. This is looking negative. In addition, we have a confirmation from the momentum. We have negative divergence on the RSI. We have negative divergence in the MACD indicator. The red impressions in the histogram have been going on for a while now, indicating that the momentum has peaked in this name. Another way to look at it, a weekly chart, and this is the conservative way, my preference, of drawing the trading channel with defined peaks and defined valleys. Now, you can play with the line and say that Apple has already reached the top of the trading channel and it is due for a pullback. I would still go with the conservative outlook that the chart has not reached the top of the channel yet. And matter of fact, the weekly chart remains bullish, but boy, those daily and 30 minutes charts for Apple are looking significantly weak. So perhaps we have short-term weakness coming for Apple. What about this chart for Tesla? The souffle 30 minutes chart. The outlier on Friday's activities, the Nasdaq was down big in the morning. The Amazon effect. Tesla was down big too, but it was bought right away. We're seeing significant uptick in bullish activities in this name, and perhaps the charts can explain that to us. We were trading in a range, 629 as support, 679 as resistance, and we had the bull to bear advantage line at 650. 657. On Friday, the chart was already trading above 657, indicating that the bulls took the advantage. 679. It couldn't close above it, but on Friday, it took that gap down in the morning, and that was enough to gather energy and dip buyers, chasers of this move higher, to push the chart once and for all above 679. The bulls have significant advantage now in this chart, and the next destination is 720. Now, we need to see how the chart trades this upcoming week. On Monday, can it keep trading above 679, or will it fall back into the trading range once again? If it trades above, then 720 will be the next target. And by the way, when we look at the weekly chart for the souffle, perhaps the majority of the negative momentum is behind us already. The chart has been consolidating in range for months and months and months. It is down year to date, but when you look at the weekly chart, we had a descending trend line of resistance. That line has been broken to the upside. Furthermore, the RSI indicator is starting to form positive divergence. And most importantly, the MACD indicator has bottomed and is curling upward, indicating that perhaps the bearish momentum in this name is peaking and the bullishness is about to return in Tesla. If that is the case, then this could be one of the most bullish big cap technology, can we call it that, technology names in the NASDAQ and the SPY, because the rest, Apple, and as you will see in a minute, Amazon, looking extremely different than this one, looking toppy, not bottomy like this one. And there goes the contrast that we talked about in the beginning of the video, the euphoria versus fear. Before we do Amazon, let's do Tulips, BTC. And by the way, I took this chart in the morning, so it is trading as I speak right now, so it could be 100% different when you get the video and you look at the chart. For now, it is clear that BTC is rallying higher and facing the resistance of 42,000. We have identified this level before, and I called it the most important critical level to break above for the laser beams. Because once you break above 42,000 and you start to close above that number decisively day after day, then the possibilities are endless. It could be even a revival of the crypto mania that we saw earlier this year. But will they break above 42,000? You read the headline in the beginning of the video. Robinhood says that retail traders are not trading crypto like they used to before. So now you're depending on the shorts and the whales to do the bidding. They can do that for a little while, but at some point, if the retail element doesn't return to the crypto market, then we get a problem. It's going to stall. Here's another pulse for retail. This is AMC's chart, the weekly chart. This is the glass half empty. We have a gap on the weekly chart that goes all the way down to the level of 26. And if the weekly chart goes down to close this gap, it will be an additional downside of 30% or so for AMC. In addition, the MACD indicator is saying that the positive momentum in this chart has already topped and peaked a few weeks ago, and the tides are turning where the bears are starting to take advantage here. We're seeing the bearish momentum about to take the front seat in this chart. Now, what is the glass half full? The glass half full is the daily chart of AMC, showing that the bearish momentum in the short term is bottoming, allowing the chart to be fertile ground for AMC bulls to create another rally higher, at least in the short term. Now, the other thing I'm highlighting is earnings. We have earnings from AMC soon. This could be the catalyst, the make or break for this chart. We know from the data that movie theaters attendance has been awful, even though economies across the country have reopened. We hear about this lawsuit between Scarlett Johansson and Disney because earnings from theatrical releases have been abysmal. This is yet another negative indicator that AMC's earnings will be awful. But hold your horses here before you start buying puts. I'm not saying it is the right or wrong move. You do you. But you got to consider this. We are already anticipating bad earnings from AMC, meaning that the risk is to the upside if there is a surprise in the report. AMC's management has been creative in exploiting this retail mania. The apes, whatever you want to call them, AMC's management has been extremely creative in playing these donkeys, offering them free popcorn or giving them the false pretense that their voices actually matter when they're not? Will they be creative in this upcoming earnings report and perhaps announce something that would be the equivalent of raw meat to the ape crowd? Hey, AMC is about to start its own streaming service. AMC is about to start a dating service for apes. Whatever it is, they could make a wild play here and spark retail enthusiasm once again. I'm just explaining the risk for you, up and down. Now, let's circle back to the intro of this video. The contrast between euphoria and fear. The change of regime that's going on in the market right now. Let's start with a monthly chart of the WTI crude oil. It has been on a downward trend all the way going back to 2007. The chart has peaked, and since then it has been a downward trend for WTI crude oil until recently, when the chart broke above the descending trending line, indicating a reversal in the trend, the first time in more than a decade, when WTI turns the negative trend, ending the negative trend, and perhaps starting a new, fresh, bullish trend. This is a change in regime once again. The underperformers during the last decades are starting to outperform. Meanwhile, the outperformers during the last decade are starting to underperform. Look to no other than Netflix, the best performer of the last decade. And now the chart is stagnating and consolidating within the same range for over a year. Here's another chart for the XME, the materials ETF, monthly chart. Just like with oil, a downward trend since the top of 2008, and it has been going on all the way till this year, 2021. The XME had a violent break above the descending trend line, ending the negative trend and perhaps starting a new bullish trend. A massive underperformer last decade is now outperforming, at least so far this year. Just something to think about here, the change in regime in the stock market. And here's perhaps the scariest chart of them all, the chart of Amazon. One of the best performers of the last decade, rising significantly higher, leading the market along with other big cap technology names. But is it a maturing company now? Are the best years of growth already behind us in this chart? Is the opportunity already behind us in this chart and many others? While oil and materials are bottoming and starting a new trend, you see a chart like Amazon stagnating and perhaps reversing. This is a monthly chart of Amazon. We have a reverse hammer pattern for July. The MACD indicator is stopping and turning negative from a monthly perspective. The question is, once again, is the best years of growth already behind us in this stock and in this company? And will the outperformers in upcoming years, perhaps this whole decade, will come out of lagging sectors of the last decade? We're talking about energy, we're talking about materials, we're talking about financials. And will the underperformers come out of the outperformers of the last decade, the likes of big cap technology names, the FANG names, the software names, cloud, all of these trends that have been dominating the market in the 2010s? Just something to think about. Moving on to the conclusion of this video. What do we have on the economic calendar this upcoming week? We have the final readings for both the manufacturing and services PMIs, but most importantly, we have the ADP employment report and the non-farm payroll report from the BLS. The Federal Reserve says pay attention to employment, not to inflation. This is at least what we're paying attention to right now in the consideration of tapering. Therefore, us market participants have no choice but to follow the guideline out of the Federal Reserve and pay more attention to employment reports. What does that mean? It means good news is once again bad news for the market. Meanwhile, bad news is good news for the market. Why? Say the ADP report along with the non-farm payrolls come out excellent, meaning that the economy created millions of jobs and the unemployment rate is diving down. This will be bad for the market. And the reason is it squeezes the Fed into the corner of tapering once again. You said you're looking for improvement in employment. Well, you got it. What are you waiting for to start tapering? What about the earnings calendar? We have a lot of names reporting this upcoming week. On Monday, we have Take-Two. This is the most important name. On Tuesday, we have Eli Lilly, Amgen, Activision Blizzard, the frat house that it is, Clorox, and Marriott. Wednesday, we have General Motors, Electronic Arts, Uber, Booking Holdings, Kraft Heinz. Thursday, Square, Beyond Meat, Expedia, Viacom, and Kellogg's. And lastly, on Friday, we have DraftKings and Norwegian Cruises. Now, we're going to have a lot of options plays for some of these. The one that comes out of the top of my head right now is in the video game names. We have Take-Two, Activision, and then Electronic Arts. Now, this is the chart that I'm watching because I already talked about it before. It is in positive bullish formation, awaiting to blast higher, trade above all-time highs. So let's say that the earnings out of Take-Two disappoint for whatever reason. Take-Two goes down. The next day, Activision also goes down along with EA. Activision reports earnings. They go down more. And now we head into EA's earnings with the name down 3 to 5% already, meaning that they've already sold the rumor. Now we got to buy the news. So whatever earnings EA releases, the stock will pop higher and vice versa. If the stock heads in with 3, 4, 5% gains ahead of time, then we bought the rumor and we should sell the news. Anyhow, we will talk more about earnings in the days to come. But for now, for this video, that's all I got for you, and I will talk to you again soon. Thank you for watching. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.